Welcome back to Accounting 201, and in this lecture video, this is the first part of Chapter 6. We're going to take a look at internal controls, and we're going to understand what those are or learn about them, how we apply them to protect company assets, and how internal controls can help avoid fraud and other errors and problems within the business. And then we're also going to look at cash and how we account for it and cash equivalents. So we have cash and cash equivalents. When we look at our incomes or in our balance sheet, we're going to call it cash and cash equivalents. We're going to identify how we record those, and we're going to identify what internal controls are and how we put them into place, and how they protect the company's assets. So to start with, we have an internal control system that basically is a list of policies and procedures that we follow that are designed to protect assets and ensure reliable accounting of our records. As an example, if you are somebody running a cash drawer and you have a certain amount of cash in that drawer, you count the cash when you start in the morning, and every time you get to a certain point where you need to deposit that cash into a safe, you're not going to keep over a certain amount of money in the drawer. You put that into the safe. At the end of the day, a manager will come over and run the register tape, and then basically reconcile that register tape with the cash that you have in the drawer and the deposits that you've made. So basically, you're going to reconcile the register with the cash, and you are not going to do that if you're the one doing the cash. You may count the cash to start with, but the reconciliation will be done by somebody other than the person running the register. This is called separation of duties, and it basically provides an accountability system so that we know that one person cannot alter the records without another person discovering that. So one of the big issues in accounting goes back to the Enron scandal of 2001. And Enron was a large energy company in Texas that went bankrupt because they had a lot of off-balance sheet debt and obligations that they were not reporting. Basically, as a result of this Enron collapse and the financial disaster that followed it, this law was passed in Congress that required auditors and managers, basically the auditors, the public accounting auditors, and the managers in the company, they both have to certify the internal control system. And the reason was because at Enron, there were internal control failures that were basically overlooked by the auditors, and because they were not examined, the company basically lost millions of dollars in its value, and the stock became worthless. Employees were out of work. The accounting firm that basically handled their accounting went out of business because they were no longer allowed to practice the way they had in the past, so they went out of business. Now, what I'm getting at here is not necessarily what happened with Enron, but what is the result? The result is we need to identify internal control processes, and this act, the Sarbanes-Oxley Act, requires a certification on behalf of managers and the auditors that these internal controls are in place and working. So you have to have effective internal controls, and auditors have to evaluate them. Now, I was not in public accounting or auditing, but we did audits related to third-party payer in healthcare. We had to certify internal control systems for certain types of activities. So basically, we had to go look at the internal controls that were in place and test them. If somebody violates this, if they violate the Sarbanes-Oxley Act, there's a penalty of up to 25 years in prison with fines. So it's a very steep penalty now for failing to really look at internal controls, report them out, and identify them. The auditors, when the auditors were working for Enron, basically they had an internal review system, and other audit firms reviewed their work and so on. But now the Public Company Accounting Oversight Board, PCAOB, is really the oversight for all public accounting and auditing. So PCAOB has the ability to issue fines and basically take away a practicing accountant or CPA's ability to conduct any audits. So that they do have a great deal of power. Now, we want to think about internal control and what we're doing. The COSO, Committee of Sponsoring Organizations, came up with these areas where basically these 5 ingredients will help assess internal control and make internal control stronger. So a strong control environment, regular risk assessment, having control activities in place, regular and good communication and information, and then monitoring of these systems. So basically this is what you would call, or this would be an assessment of the risk involved with it and a way to avoid the risk or mitigate it. So internal control basically is going to identify who is responsible for what. You want to know who is responsible for a specific activity. Like I said before, if you run a cash drawer, you cannot be responsible for reconciling the cash with a register tape. Somebody else is going to do that. If you are the one receiving the checks from customers, you are not going to be allowed to be the one to make the deposit. There are a lot of separation of duties that we're talking about. When we talk about these responsibilities, the separation of duties is for that purpose. You want to maintain adequate records. That is, every day that you're reconciling cash, you want to identify that you've done that. You want to have some kind of a form or some kind of a procedure that's checked off and identifies what the record was. One of the things that you can do to mitigate risk in a company is to insure the assets and bond employees. And a bond basically is a guarantee that if an employee does commit fraud or does take money from the company, that money is basically covered by an insurance company who will then pay the company back. When we talk about separation of duties, this is exactly what I'm talking about here. Separate the record keeping from the custody of assets. When we talk about cash, what we mean is the person doing the bank reconciliation is not going to be the person that runs the cash drawer. You want to divide responsibility. Again, that's separation of duties. That's a critical piece of this. And then apply technological controls if you can. There are technological tools that you can use to help strengthen controls. And then finally, do regular reviews of these controls. You want to make sure that they are there and they're in place. So when we talk about responsibility, we're talking about really identifying who is doing what. And by the way, one person is charged with the responsibility, not multiple people. So each individual has individual accountability. And if we're maintaining records, maintaining adequate records would be things like bank reconciliations that we do every month. So if we have several bank accounts, we're going to do a bank reconciliation for each account. We're going to keep that reconciliation or the records for it somewhere. It may be an electronic record, but we're going to have a record of it somewhere. We'll have a chart of accounts to identify the accounts we should use. pre-numbered forms like sales slips and order forms. That'll help us to keep track of the forms and avoid any kind of problem with an order or sale. Computerized point of sale systems. This would be for someone who is really wanting to track their inventory, for example, like Walmart. You're tracking at point of sale. You have an update to your inventory, and by the way, this can help you identify shrinkage or theft if you have a problem with that. I already mentioned insuring assets and bonding employees. I'm not going to mention that again here. This is probably one of the single best approaches you can do, especially when you're working with cash. You do not give control. The person who has control or access to the assets, they cannot have access to those accounting records. They have to be two different people. There needs to be a separation, because if one person controls both the asset and the accounting records, they can alter the records and basically commit a fraud on the company by taking the cash. And then again, dividing responsibility, like I said, separation of duties. It's a huge thing in internal control. We really want to make sure that there are two or more people who have responsibilities divided. They cannot have the total control over the assets. Now, one of the technological controls we've already mentioned is the electronic cash register, where we basically keep a record of each sale, and then we can identify and reconcile that cash register to the cash in the drawer. We also, when you clock in at work, you have your own ID badge you can scan, and so on. So one of the things that we need to think about when we're talking about this is the possibility that there could be a fraud or it could be a problem if internal controls do not work. These are internal controls, and these are the benefits of it. You have separation of duties, you do more testing, you reduce processing errors, and basically you have evidence of the processing that you're doing. Now, there have been cases where there are frauds that have taken place. There have been a couple of big ones in the past. Enron was the one that I mentioned earlier, but there was also one with Health South Company. And Health South, they're still in business, but probably around the same time of the Enron scandal, there was a scandal that developed in the late 90s, early 2000s with Health South, where the CEO in charge of the company basically wanted to meet Wall Street expectations for earnings, and when it was clear they were not going to meet those expectations, he assembled the accounting staff and said, we need to find these transactions so that we can meet our expectations. And so what really took place was, at that time, they were creating transactions that were below the auditor's threshold. So, for example, as an auditor, you typically set a threshold that a transaction must be over a certain dollar amount to be material. And so they basically discovered, well, the auditor's threshold at Health South had been something like 5,000. So they were creating transactions, not actual transactions, these were false transactions below that amount in order to meet earnings expectations on Wall Street. By the way, I looked this up. We had Weston Smith come to Ball State some time ago and speak, and Weston Smith was actually the CFO that blew the whistle on Health South, and basically when he was working with Health South as a CFO, the CEO in charge of the company wanted him to continue to fraudulently create these transactions and certify the financial statements and internal control according to Sarbanes-Oxley. Weston Smith decided he couldn't live with himself doing that, so he blew the whistle on HealthSouth and basically reported that fraudulent accounting activity. And many people from HealthSouth from that era and at that time did go to jail for some of their activities. But again, that was one of the impetus, one of the things that really created an impetus to create the Sarbanes-Oxley Act to put an end to the fraud, or basically identify some steps to take legally to avoid the same kind of fraud from happening in the future. So moving on, we're going to talk about cash and cash equivalents. Obviously, you know what cash is, right? Any dollars that we have on hand, any cash that we have in a cash drawer, obviously any coin that we might have back in a safe where we're keeping that so we can make change if we're selling goods. So basically, cash like this is very liquid, very hard to track, very easy for somebody to walk away with it. So we need a very effective system of internal control for cash. And one of the things that we need to do with it is this step right here. You know, our routine where we say, okay, every day we're going to take, or maybe even more often than once a day, depending on the size of our business, we're going to take our cash to the bank. We're going to deposit it right away. We're not going to keep much cash on hand. So when we get to a certain level, we make a trip to the bank or we deposit that cash in the bank. One of the things that you can do here to avoid handling more liquid cash is to do more transactions by electronic funds transfer, or basically a check. Although most people are not using physical checks anymore. I think that's dropped off considerably. But EFT transactions are really big because they're very quick and they're very secure. And so again, you don't handle the cash. It transfers by wire from one bank to another. Okay, so when we talk about cash equivalents, cash is obviously what I mentioned earlier, and they give us a list here of things considered to be cash, but cash equivalents are also any highly liquid investments that we have. So it might be that we have some excess cash on hand and we decide to invest it in short-term T-bills or something like that. And if we do some short-term investing where it's liquid and very easy to cash out, something like a short-term T-bill or something like that, we can actually cash out of that very, very quickly. It's a very liquid investment. So we do not want to get, especially when we're talking about cash equivalents, we do not want to get involved in the long-term investment strategies. This is going to be just a place to park excess cash so that we can actually earn a little bit of interest on it. Okay, the goal here of cash management is really to plan the cash receipts so that we can make our payments when they're due. And this is a very key point. We do not want to keep, we want a minimum amount of cash on hand. We do not want to have, we want enough cash to operate, but we do not want to have excess cash on hand. So again, that's cash management is a very important part of this. When we are effective with our cash management, we are collecting receivables. We pay our liabilities, but we do not pay them before they're due. We keep only necessary assets. We plan the expenditures and invest excess cash. That's what I was talking about here with cash equivalents. we'll put that into some kind of short-term investment. All right, so when we look at internal controls and cash receipts, here's an example. This graphic illustrates that the people involved in tracking cash receipts do not have the total authority over the cash and the accounting records at the same time. So you have somebody who's in the sales department, maybe a cashier department. They're selling goods, they're collecting cash, but they don't do the accounting records. Instead, you have somebody over here in the accounting department who tracks the bank records and reconciliations, and by the way, would receive some kind of a communication from these departments as to what was going on with those transactions. Finally, what happens if you're in a cash register and you're taking care of your customers and you make a mistake and you count out the wrong cash or exchange for a customer or something like that? You make a mistake during the day. We have this thing called cash shorten over, where basically if we miscount the cash, what we're going to do is we're going to count the cash that's in the drawer. So we have a hard cash count of whatever amount of money that is. Let's say it's $100. And then when we run the cash tape or register tape, the register tape says we should have $96. What that means is you have $4 more than what you should have, and so the difference goes into this basically into cash shorten over. So this would be sales right here, right? So that's the register sales. That would be sales of 96, and the difference would be to cash shorten over. All right. In this case, the cash is over. Somehow we got $4 more than what we needed. We thought we had $96 according to the register tape, but we counted we had $100, so we're off. Now here's an example right here of the same thing. The cash register's record shows $625, but the count of cash is $621. This means that you're short on cash. When we were up here, we were over on cash. We had more cash than what we had sales. Down here, when we say we're short, it means we have more sales than we have cash. So they have $625 in sales, but only $621 in cash. So the difference, $4, is going to be cash short in this case. But the shorted over account will keep a running total of what those are. So we could go back and forth on those several times. Now when we receive cash by mail, here's some steps that are, and by the way, having had some audit work in this area and working with healthcare providers, these steps are very common. When checks come in, usually two people are opening the mail. That way one person can't slip a check in their pocket. The cashier basically prepares a deposit slip for a deposit going into the bank. And by the way, that's not the people here. These people are just bringing the checks in. And then whoever is doing the accounting records or the bookkeeping is going to record the amounts in the accounting records. So you have a separation of duty. This person here or these people here are going to be the people who receive and open the mail. This person will be somebody in the office who will look over the records that they've prepared and prepare the deposit. And then this person is not going to be doing the deposits at all. They're just going to be reconciling the bank statements when they get those from the bank. Okay? Now, when we talk about controlling cash payments, one way of doing that is through a voucher system of control. What that means is a voucher is needed before you can actually pay for anything. So basically the voucher is the approval, okay? So before you're able to order anything, a voucher system requires that you have a voucher number, in order to make the order. This slide right here shows you kind of what that is in Exhibit 6.1. If you want to look at that a little more detail, it'll explain this. But basically the voucher system of control will ensure that purchases made have approval and that payments made are approved. Other kinds of controls that you could have in place if you're looking at cash disbursements include having dual signers on the checks and so forth. Well, at this point, this concludes the first part of this lecture video. I'll be back with another one where we'll go through some of the procedures that we need to be thinking about. Take care, and I hope you have a great day.